Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. And folks, good morning. I'm just thinking, how do you even start a day like this, right?
Yeah.
By wearing a shade of green as bright as that.
That could be the only green. That could be the only green you see on the screen today. But I think the consensus is calling for a Black Monday. So let's see whether or not we do get that. But, you know, all of the last 48 hours, everyone's been telling you about those Black Mondays in the past and how we are bracing for one. Maybe the street doesn't oblige, but let's see. That's just hope talking.
I think you guys have seen that movie, Margin Call?
Absolutely, absolutely.
So there's one, the one scene where, what's the name of the guy? The guy who runs the trading floor. He assembles all the traders in the dealing room and he says, well, I foresee significant volatility for the foreseeable future. And I think that one line, nicely summarizes how things are. And it is a significant sort of volatility, and I mean volatility all on the downside for now. So let's take it from the top. I mean, of course, I think most of us who are sort of tracking markets, commenting on it, or I mean, if you're trading and investing, you've been, of course, glued to your screen, social media, etc., and you've been sort of consuming everything which is coming on. And it's been sort of a torrent, really, in terms of opinion and views which are out there. But let's just take it from the top. The most important things, right? So we left off last Friday with these tariffs. And as we shut shop on Friday, right around that time, China imposed 34% retaliatory tariffs on US products. And as you kind of wound down a very bad session in the US, and I'll get to that in just a bit, the hope was that over the weekend you will see some, the outside hope, outside chance that you perhaps will see, the US administration and Trump, who don't seem very bothered with the US, with the market fall, perhaps after a 10% two-day decline, bothering about the fall. Well, these are the two comments which tell you otherwise. So Trump essentially posted on Saturday saying, hang tough regarding tariffs, right? This is one. And the second is US Treasury Secretary Scott Bessent, who's, one of the most respected voices in financial markets, 30-year veteran in markets. He said more than 50 countries have called the US administration for tariff talks. And he went on to add, it's not the kind of thing you can negotiate away in days or weeks. So the import of this is very clear. They are not backing down. And I put this piece out on the wall as well on Thursday. This is right after the announcement of tariffs Liberation Day, that they're not looking for quick or easy wins. These comments kind of suggest that that is very much the case. Now, very quickly, that's the quote as far as Bessent is concerned. Very quickly, I want to take you through what happened on Friday. The S&P was down 6%. The Nasdaq was down about 6% as well. Friday was the highest volume session in the history of US stock markets. And to add to everything out there, and there were a lot of people who were saying 10% in 2 days, the famous the plunge protection team, as it's called, right? They'll come in and they will start to do something and they will at least start to make noises. And one important, perhaps the most important element of that team is, of course, Powell, Fed Chair Powell, who had this to say: don't need to be in a hurry to cut rates. And I think that exacerbated the fall, especially the move in treasuries. Now, in the last 2 days, the S&P is down 11%, Nasdaq is down 12%, the Russell 2000, the small cap index in the US is down about 11% as well. These are all just stats. The US equities alone have shed about $5 trillion of market capitalization in the last week, bulk of it, all of it coming in the last two sessions. And it's very clear. Just look at Wix. Wix at 45 is not sustainable. But these are not sustainable markets. These are not normal markets. Generally, people are moving into the self-protection mode. Survive, and then, of course, we will deal with what's to come. And just for some context, right, the two-day fall in the S&P has been matched only 3 times in modern history. That is the 1987 crash, the 2008 crisis, and the COVID 2019 fall. To go back to another instance, you have to go all the way back when Germany invaded France in 1940. I hope that's where the sort of comparisons end, but that is the extent of what we've seen. Now, where do we go from here? Tariff, trade negotiations, etc., will continue. They'll continue this week. They will continue over the next many weeks as well. The more optimistic, constructive take is that they've kind of taken throw the baby out with a bathwater, like a kitchen sink approach, and from here you perhaps will see somehow a path to lower tariffs. I mean, clearly markets like this not really sustainable. It looks like uncertainty is, of course, going to be the name of the game, but the peak uncertainty in that sense, the point has been passed. So maybe we're going to plateau into ongoing uncertainty now. High uncertainty, but the peak perhaps is kind of behind us, and that is important. Just one thing, right? So far, everything we've heard from the Trump team seems to suggest that they are not backing off. But be mindful for headlines, and I said this on Thursday and on Friday on Editors Roundtable as well. We are one headline away from things starting to look, at least bottoming out kind of a formation. U.S. credibility has taken a hit, and that is going to take a long time to repair. But the point is, one headline, for example, Vietnam has offered that they're going to sort of bring tariffs down to zero against the U.S. If you see a headline from the U.S. saying that, we are ready to do the same. We are bringing down tariffs on Vietnam, and we're not going to be charging them whatever we said we will. That will be taken as a signal that, they are in this to negotiate and bring tariffs down. So it'll take one headline, possibly, and hopefully it'll come sooner than more damage has to be done, but we'll see. Just to tie in the levels here, the Nifty broke many levels, supports of 23,150, 23,130. The rising trend line, the 20-day, all of it, by the way, went on Friday. The big level on the downside, of course, is the 3rd of March low, 21,964. And that's about 1,000 points, almost exactly 1,000 points away from where we are. But the GIFT Nifty is indicating, almost that much in terms of a cut on the way up. Resistance 20 hourly, 40 hourly, but I don't think we need to worry about that now. Nifty Bank, much stronger. It's not broken any levels, key levels, or seen any big breakdowns here. We need to break above the high of 52,063 to rule out a correction. But I think here also you need to be focused on the downside, because it can't be that the Nifty Bank continues to cruise higher in oblivious fashion. So we'll see here. The big sectoral damage, and this is largely two-day done damage. IT index sold off 9%, and the metals index was down about 7.5%. GIFT Nifty gives you a quick sense of how we are likely to start. I think 890 points down is the indication. Surabhi.
Getting ready for quite a wild ride. Let's just hope that the ending is better than the beginning. And I think we'll take heart from that. There are comments coming in from Finance Ministry officials promising more support for exporters. The Finance Ministry right now seems to be maintaining a stance that India's growth projections do not need to be altered in that band of 6.3% to about 6.8%. And they're saying that they're in discussions. Commerce Ministry is in discussion with exporters, and more support will be provided if needed. Now, let's very quickly take a look at screens. And what are the screens saying? How is Asia gearing up for, I hate using that quote, but quote-unquote bloodbath or crash? The Japanese market had sunk as low as 8%, the Nikkei. From there, it's recovered a little bit. It's 6% lower. But the other markets, look at Hong Kong is down 9%. Taiwan's down about 10%. Mainland Chinese markets are down about 6%. The Nikkei, like I'm saying, it's recovered from an 8% crash to about 6%. Australia was down 6% when it opened, but now it's down about 4%. So marginally better. Let's see how it goes through it. Before I go on to talk about any of the other cues, the single most important cue is the man himself, right? Donald Trump. So he's made a statement, and I wonder if this is some sign of a thaw. Could there be a thaw? Let's just listen into what the U.S. president said. This was on Sunday night. He was on board Air Force One, and he made that statement saying that he doesn't want markets to go down, but then sometimes a medicine has to be taken.
Going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger, and eventually it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I think it's I don't want anything to go down, but sometimes you have to take medicine to fix something.
So this is what he's been saying, hang tough, sometimes we have to make a medicine, the economy ultimately will be supercharged. This is all a series of tweets over the weekend, but what he did do, which was interesting, was that he decided to extend the deadline with TikTok. TikTok's ban was supposed to come in place. He's extended by 75 days, saying that we'll talk to China, and of course China is very upset with us because of the tariffs, but we'll see, we'll negotiate with them. So let's see what Trump says next remains, of course, the biggest cue to watch. Now, what has China done? China obviously levied 34% tariffs. Let's very quickly pull up the statement. What did the country state commission say? They said the practice of the U.S. is not in line with international trade rules. It seriously undermines China's legitimate rights and interests and is typical unilateral bullying practice. That's how China has responded. How has Europe responded? Europe is going to go through a series of very important meetings today, and Reuters is indicating that by the end of Monday, Europe will probably come up with retaliatory tariffs, more select in nature, but to the tune of $28 billion worth of U.S. imports that are right now coming into the EU. Big talking point there is bourbon whiskey. If you'd start taxing bourbon whiskey at 50%, will they tax French wines, Italian wines? So that's one big talking point. What have we seen from companies? Tata Motors, for instance, halting all shipments of JLR going into the U.S. till they figure out how to navigate this situation. So that's what's going on. Let's talk about the fall now. Just very quickly, numbers. That argument of whether India has already fallen in the past and therefore we may not fall more, does that hold? These are the two-day moves on the US market, down between 9% to about 11.5%, NASDAQ being the worst hit. 2 days, US markets fell so much. India, in contrast, has fallen only 2%. Now I come to that argument. We want to believe that we've been falling since September, so it's okay. We've already seen the fall. Is that really true? Is that how you should really look at it? 6 months. Now let's look at Indian markets in the US over 6 months, and we talk about the correlations. The US is already down because of this, absolute dreadful fall in the last 2 days. Even if you look at 6-month pricing, we are down far lesser, just about 7.5%, but the S&P, the Dow, the NASDAQ, all these indices are down. Look at the NASDAQ is down 13%. So don't know if that argument holds or not. Let's quickly then come down to the immediate cues, which is flows. Flows have been negative. That hasn't changed. 3,500 crores of selling on Friday once again. Even domestic institutions were on the sell side. Remember what Nilesh Shah said to us on this very show, that if we feel we'll find better bargains at lower prices, there's no reason to buy immediately and give an exit to FPIs. It just tells you how domestic money managers are also thinking. And finally, in the midst of all this, earnings season is starting off. We'll hear from the tech companies very, very soon. I'll just leave you with what Nuvama is saying. Sobering thoughts coming in. Nuvama is saying Q4 Nifty earnings will be up only 2%, which means for the year will be up only 6%. More importantly, they're saying that consensus estimates of 13% FY26 Nifty earnings growth, all of them are at risk if these headlines continue to be as they are. But let's see, like Prashant is saying, we're one headline away from a change. And Nigel, let's hope we get that soon.
Well, consensus is expecting a Black Monday, and I hope that we don't see that. But hope's not a data point, so let's get you a couple of data points then. In the last few trading sessions, equity as an asset class across the globe has got sold into. While we have seen a shift towards safer assets as well. It's not the time to be brave, but maybe it's not the time to panic as well. That should be the case as well. And just to give you a sense of, India has outperformed the last couple of trading sessions. And if you look at the volatility index, out here in India, it's up only around 8%. In the United States, that index doubled in the last week itself. And that gives you a sense of fear out there. So that's actually a positive sign. Well, if you look at the FI net short positions, the short positioning in the last week has gone up by close to around 3 times. So there are shorts in the system. This market was devoid of shorts. Now there are some shorts in the system. In percentage terms, the short positioning is at around the 71% or thereabouts. A few sessions ago, it was at around 60%. That's moved to around 71%. The clients, well, the long positioning was very, very low. It was only around 8,000 contracts. That number has moved up by around 4 times thereabouts, currently holding at around 40,000 contracts. The PCR, that's moved to the lower end of the range. A few sessions ago, it was at around that 1, more than 1. In fact, that's cooled off to around 0.74. At around 0.65 odd, technically you normally get a bit of a bounce. And how do you see such a big swing in the PCR ratio? Because the call writing was very, very aggressive. Between the 23,000 called, 23,200 call, more than 1.5 crore shares were added. And that's the reason why the PCR has come down. Putting in the data that we've seen, the technical levels as well as the options data, you don't want this lower level to get broken out. This is the recent low. 22,000 level becomes extremely important, and the bulls will want to defend this. Technically as well, this is a very, very crucial level. On the upside, no one's talking about it, but the crucial resistance will come in at 20 to around the 50 DMA. What's been working for us? The Nifty Bank. Just take a look at the outperformance you've seen in the last few trading sessions from the Nifty Bank itself. Because the Nifty Bank is more or less flattish in the last few sessions, while global markets have sold off, and the Nifty itself is down close to 2.5 to around 3%. So the Nifty Bank will be the one that needs to fight for the bulls from here on. I'll also keep an eye on the FMCG index, because in times of crisis, that has put up actually a relative outperformance. In this recent fall, actually it's been a relative underperformer, and Motilal Oswal has put out this note. There's a possibility that the consumption pack could be the one that could be the one that outperforms. So let's see, as it's done in the past. Finally, near-term headwinds for all equity markets, India included. But can India come out stronger? I think yes. There's a hope of an FTA agreement being signed, bilateral deal as well, and retaliation to Trump's tariffs may not be the way to go about it. Secondly, the competing nations like China, they have been placed under higher tariffs in comparison to India. So that's a net benefit. Goods exports to the United States, it's sub 2% of our GDP, and services have not been tinkered with as of now. So that's another good sign. And finally, commodity prices have melted down. That's not a good sign, right, for the globe. But from an India market perspective, when you're bracing for rate cuts, it makes the RBI's job relatively easier as well. So put this together, it's going to be a tough phase for Indian equity markets, but I think we come out stronger in the longer term.
Will he walk back and retrace some of those steps? I guess that's the biggest question as we're looking at markets this morning and this week. So what's the equity call? Let's kick it off with Chetan Seth's view. He's from Nomura. He's saying US stocks are approaching technically oversold levels, but valuations not yet comforting enough. Overall, he says they continue to recommend defensive positioning on Asia ex-Japan stocks unless US policy course reverses. He says they are particularly cautious on Taiwan, Korea, and also China equities, given the clear escalation in US-China tensions, while they consider India should be the preferred choice in the region for investors who are looking to buy the dips. That's a view coming in from Nomura.
Okay, Matt Orton is with us, Chief Market Strategist at Raymond James Investment. We also have Arvind Sanger, Managing Partner, Geosphere Capital Management. Gentlemen, great to have both of you here. Appreciate it. What to even ask? It is what it is. It is all red. It is all bad. But let's try and look ahead. Matt, what's your sense? How are things going to progress from here? What should we see?
Hey, good morning, Prashant. And it's difficult to know exactly what the path is, but I think what we can say is that the current state that we're in with respect to where, Liberation Day, April 2nd tariffs came in, that's not going to be the ending point. I think what we've seen from the administration and from the rhetoric is that there's a potential that tariffs could increase depending on retaliatory measures that are taken, but tariffs can also decrease. And I think the idea of bilateral trade dealers are going to be very, very important. I think India in particular stands in a very, very attractive position. And what I've been urging clients since the start of this year has been to lean into diversification across asset classes, across geographies, across sectors and industries. And this is also not the time to be selling. This is the time to be continuing to lean into being defensive, because this too shall pass. It might take longer than we think it's going to, but there are places that we can hide in this market. And I think that's the main message to give to clients, is that this is not the time to completely liquidate, because when good days come and you miss them, that can be very, very bad for longer term returns as well. But there are places to hide. India is one of them that I like a lot. And when you look around the rest of the world, other markets like Brazil could also be interesting, as well as just your more traditional defensive sectors.
Got that. Arvind, we can, of course, take stock of the damage. And it's really bad, and all kinds of course, historical comparisons. But let's try and look ahead. Do you think, and I was saying this earlier, none of the comments from Trump himself or his top officials indicate that they want to walk back. They're not looking for an easy, quick win, at least not right now. But, these targets are moving all the time, very fluid situation. But do you think if we, over the next, say, 1 week, whatever, we get a headline saying, well, say, one country, let's take Vietnam as an example, that they're ready to reciprocate by lowering tariffs, what they've imposed, very high tariffs on Vietnam. Global markets will take that as an indication, and that'll be the start of some stabilization at least. What's your sense, Arvind?
I am skeptical if EU chooses to retaliate, which they're indicating they might do in the next 24 to 48 hours. Then what we have is the two biggest trade blocs, which would be China and EU, taking the approach that appeasing Trump has not been a path to having a stable situation in terms of tariff, because Trump always comes back, President Trump comes back and tries to recut the deal, as the North American countries have seen with USMCA in his first term, and now insisting that, that was a bad deal. So I think that the problem is that, yes, you can have, Vietnam or Afghanistan is the latest one we heard offering to lower tariffs. But I don't think that's the real problem. The problem is that if the major economies in the world, like China and EU, decide to dig in and take retaliatory action, then things might have to get a little uglier before they get better. So I don't think Vietnam is going to be enough to turn the ship around. I think it's going to be some major deal. Maybe TikTok becomes the excuse for a deal with China, but something needs to happen. But what President Trump, I don't think, gets is that the Chinese or the Europeans need a win-win. President Trump wants to believe that it's going to be a win-lose and everybody else is going to bend the knee, as they say, to accept America's greatness. And I think that is where the problem comes. And I think things might have to get worse before they get better.
Yeah, I'll take your point, Arvind. Completely understand what you're saying, which is why I've done nothing over the weekend except just look at every single tweet, every single social media post, and it's very hard to sort of form trading opinion or positions based on that. You don't know what he's doing next. But like you said, if you just follow the nature of those comments or bites or posts, the fact that he's extended that TikTok deadline, he's saying that, oh, of course, I understand China is hurting, but, now we need to negotiate a better deal. What would the odds be, is a weird question, but what would the odds be of some sort of a walk back? Because that could immediately induce a massive short covering rally or some sort of a relief rally in markets, right? Would you bet on that, Arvind?
I would not, because I don't think China is going to want to seem to be forced at so-called, like a gunpoint to make a deal. I don't think that is in China's best interest to be seen, or Xi's best interest to be seen as kowtowing to Trump and being forced by Trump to do a deal. So I think that's
Arvind. In fact, I was hinting at the other part, that Trump, look at the kind of opposition and their protests in the US on the streets. Almost everybody, including Bill Ackman, is now openly saying that this is not good for the economy. This is not good for stocks. It's really not good for anyone. So given the kind of pressure that's mounting, the perhaps quote-unquote rift between Musk and Trump himself, would you expect Trump to walk back? Is that a wager that you'd be willing to take, or is it too risky a bet?
Too early. They're not showing signs yet of giving in. I think we need to see tweets from President Trump indicating something changed.
Okay.
All right. Hi, good morning, gentlemen, and good to see you. And it appears it's going to be a difficult day of trade. But Matt, let's come across to you. You've been quite bullish on Indian market prospects, but you're also talking about asset allocation. So what's the asset allocation strategy as of now? The global equity markets as an asset class have got sold into. What would be the exposure to fixed income, to gold, to equities? And within equities, how much of it would India get, from your capital allocation perspective? Because in the past, you've spoken about the Brazilian market as well, and you believe that as well could be decently placed. Please go ahead.
Yeah, all great points, Nigel. And I think from an asset allocation perspective, one of the most important things for investors to look at is what's their balance as well. There's no one blanket asset allocation that's going to work. I think clearly heading into this, it would have been great to be completely in fixed income and gold and not in risk assets, but that's just not reasonable. So I think it's how do you marginally lean into some of the things that are likely going to work in the near term, and how do you lean out of some of the areas of more risk within the market without hurting yourself when we should see a flip in this. And I agree with Arvind that I think we're away from actually seeing the actual bounce. I'm urging clients not to buy bounces in this market, or at least in the US, and I'll call it the global equity markets, because I do think there's going to be more tit for tat before we actually get to the end of this. But to answer your question, Nigel, I think from an asset allocation perspective, you want to be overweight in risk in low risk assets, so treasuries. And I think you want to balance duration just because rates have come down so much. But I think it's more likely than not you are going to get rate cuts in the US, more than I would have expected, say, 1 week ago. So duration can be your friend. Gold as well, and gold miners, which sold off significantly on Friday, I think can be a tactical opportunity for investors because they're levered to gold. It's not part of the tariffs that are put in place right now. And so I think that's an area that investors can also find a little bit of protection in the overall market. When you look from a global perspective, though, like I said before, countries like Brazil, where they're a little bit more insulated, Latin America as a whole has been a little bit more insulated from the tariffs that we've seen. Brazil's also an alternative to some of the goods that could be caught in the trade war, like U.S. agriculture. During COVID and during the Ukraine war, they provided significant amount of agricultural resources. They also rich in minerals. So that's another country to keep on your radar, especially if this could be a reason for the central bank to keep on an easing path. That could provide support to equities. And the Bovespa only has about a 1% exposure to U.S. revenue. So that is also very, very advantageous. And finally, you get to India. India is also a much more domestically driven economic story. The government's in a good place. So I think the earnings growth trend can continue even during this tariff war.
All right. No, absolutely. Got that. Arvind, for India, right? You heard Matt talk about India a few times. I mean, we're not significant trading partners with the US. You said to my response earlier, you said, well, it has to be a big country, EU or China or something, for it to be a signal that things are thawing a little bit. Smaller countries would not matter. But that aside, for India, I mean, our deficit is about $40 billion, right? We buy some $80 billion of oil anyway. We import every year. And if the aim for the US is that let's get this 40 billion, I mean, we want to wipe out deficits with all trading partners. I mean, India can very well say, well, we'll buy oil from you instead of buying it from Venezuela or the Middle East or whatever. So it can be done in that sense. You think that's the way forward? And in any case, I mean, as I said, direct trading is not that not very high. The impact, of course, is through financial markets, etc. Go on.
Yeah, no, I agree with Matt, everything he said about India. I think that India is obviously much more domestic-facing economy, and so that's less of a concern. And I think India's deficit can be, like you said, fixed. Don't forget LNG. We import LNG largely from Qatar, but US is the largest LNG exporter and has a lot of capacity coming on. India could sign deals with American companies on LNG. And obviously, U.S. as an oil exporter. So those are easy ways to show President Trump that India is, serious about cutting its deficit. And it seems, fortunately for India, that President Trump is fixated on goods trade deficit and is not at all paying attention to the hidden gem of India, which is its services exports. And so that can continue to grow. And so I think India is actually in a unique position where services surplus is quite significant and offsets a significant portion of the trade deficit. So therefore, I think that India is an excellent position to be able to get some kind of a win. Although even if President Trump doesn't completely remove the tariffs from India, as we've discussed before, India is probably both relatively and absolutely in much better shape than most other economies in the world.
Absolutely. And let's hope it doesn't start looking towards services. We have enough going on with goods and tariffs and deficits over here. Thank you so much, Matt and Arvind, for weighing in on what's a really important and difficult morning for global markets once again. Well, that's some global opinion to start off with. We have a lot coming up over. Okay, so we'll come back, and lots of stocks will be on the radar today. We're looking at names like Delivery, Bajaj Housing Finance, Godrej Consumer Products, Nykaa, Metropolis, Jubilant Food Works, IGL, and Kalyan Jewellers, all on the back of positive news flow. There's Tata Motors, however, IndusInd Bank. These are the two that have some negative news around them. We'll tell you more about it in just a minute. Welcome back. Just a quick check across Asia. Markets are obviously still down. The cuts, 7% still on Japan. You've got Shanghai down about 5.5%. Hong Kong is still down about 9%. Taiwan, 9%. So, yeah, it's tough. Not much changing there. Singapore is down 7% as well. It's a complete wipeout. And for us, so obviously, this means that the implied open has been indicating that we'll start at least with an 800-point plus sort of a gap down. There you go, 858 points. That's the nifty implied open. Okay, so we know it's going to be a difficult opening, but what about individual stocks? There is a fair amount of news flow, and we have to, of course, get you up to speed with it. Our team is standing by with the CNBC-TV18 list of top stocks to watch this morning, guys. Morning to all of you. Abhishek, why are you watching out for IndusInd Bank?
Well, there is a business update that has come in for IndusInd Bank, and it looks like YOY weakest business momentum that you are seeing in last 17 to 19 quarters. And sequentially, the loan growth has declined for the first time in last 9 or 10 years or even more. So take a look at the deposits. They are up 6.85% YOY and about 0.4% sequentially. YOY, it's the weakest deposit growth that you are seeing in last 19 quarters. A calculation shows that the CASA in absolute value is down about 7.5% YOY and about 5.65% sequentially. So the CASA ratio is one of the lowest that you are seeing in last 10 years, that is 39 quarters or more. It has come in at 32.8% versus 34.9% in the previous quarter. Now the retail deposits, that's also shrunk for them by about 2% on a sequential basis. Advances growth very bad over here, 1.35% growth on a year-on-year basis and a decline of more than 5% quarter-on-quarter. So YOY, it's the weakest growth that you are seeing in advances for IndusInd Bank in last 17 quarters, while sequential decline is one of the highest that you are seeing in last 9 or 10 years. Calculation shows that the credit deposit ratio is at 84.6% versus 89.6%, which is a 9-quarter low, and therefore, can put pressure on the net interest margin in a high interest rate scenario. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Sudarshan. He's here to tell us about the news flow on Tata Motors. Morning, Sud.
Morning, Nigel. So Tata Motors has announced that JLR will discontinue its shipments to the US market. So in 2024, JLR in the US market sales had formed nearly 31% of its total volumes. Now CLSA believes that of total 31%, that 60% of the sales are for the segments that are priced above $85,000. Now, if that is impacted, CLSA believes that there would be a minor increase and there can be a 10% decrease in the volume. But the major impact will come in the price that is below $85,000, which is in the range of $50,000 to $85,000. Now, there the impact can be 50% fall in the total volumes. And if the total impact plays out, there can be a decrease of 25% in the JLR total volumes. Now, MS believes that if the auto tariffs remain, JLR could again go free cash flow negative in FY26 as well. And India's slowdown and weak FCF profile of JLR may take stock closer to its bear case price of 416. So it's a big fall that MS is seeing even from the current levels. And overall, I'm going with green for Tata Motors because of discontinuation of JLR shipments to the major markets like US.
Okay, Sudarshan, thank you very much. Just illustrates how deeply disruptive these small tweaks in numbers, tariff numbers, can be for individual companies. Thanks for explaining that to us. Let's go forward, talk about delivery. Manglam, what's the news here?
Well, Nimesh had alerted us in his D-Street chatter, and now it's come true, which is that they've gone ahead and made an acquisition. The acquisition is that of Ecom Express for close to around 1,400 crores in cash. Remember, this is an end-to-end technology-enabled logistics solution provider, which does revenues of almost 2,600 crores as of last fiscal. Delivery itself can afford it. They have cash of close to 5,500 crore rupees in their books. So 1,400 crore acquisition is what is good for them. What's good in this acquisition? That it strengthens their command over e-commerce logistics further. And also it's at an 80% discount to the company's own previous valuation that was done. So Ecom Express was looking for an IPO that did not go through. From there, there's been an 80% write down on their value. So as a result of which, it's a deal at a good price. The other thing that we'll have to watch out for, however, is that Ecom Express is still loss-making. So how do they fix that is point number one. And secondly, nearly half of their revenues comes in from just one client, that's Meesho, and that too itself is reorganizing its distribution. So how do they navigate through that stress is another thing that we'll most definitely watch out for. But an acquisition at a decent value in the same space is positive for delivery.
All right, Mangalam, thank you very much for that. So that is delivery in focus. Bajaj Housing Finance is the next one we're going to talk about. Abhishek is here with details. Abhishek, morning.
Morning, Prashant. So strong numbers with respect to the business momentum coming in for Bajaj Housing Finance. The securitization portfolio has increased a lot in this quarter. So take a look at the disbursements. They are up 25% YOY and about 13.5% nearly on a sequential basis. The overall loans have grown by 25.5% YOY and about 4% sequentially. However, the AUM growth is higher than the loan growth because securitization for them has increased. So AUM growth is at 25.5% YOY and about 5.9% quarter on quarter. So securitization book that has increased by 19% quarter on quarter, and this also helps in your net interest margin for the NBFCs. So overall disbursements to AUM ratio has remained steady at about 44.7% versus 45.7% in the previous quarter. So strong numbers from Bajaj Housing Finance. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's go back to Mangalam. There are a few quarterly updates that came over the weekend. Mangalam, tell us about Godrej Consumer as well as Nykaa.
Well, for Godrej Consumer, there has been sequential recovery. Remember, the third quarter was a very bad quarter for them. It was a washout, flat volumes. The company then said that they are focusing on improving volumes, and that's what they've done in the fourth quarter as well. Fourth quarter underlying volume growth will be in mid-single digits for India, and revenue growth will be in high single digits as well. This will be led by mid-teens volume growth in their home care business and mid-single digit decline in the personal care business. EBITDA margins, despite the inflation that we're seeing in raw materials, should be stable at around 20% as what we saw in the third quarter. That's because the company's gone ahead and taken some price increases in their soaps portfolio as well. And as a result of which, consolidated revenues growth seen in high single digit with mid-single digit underlying volume growth, seeing mild green in Godrej Consumer on the back of this news. But remember, there is weakness across the market. For Nykaa as well, near 30% gross merchandise value growth in their beauty business. That's a positive. We've seen mid-20s net revenue growth for their beauty business as well. Fashion vertical slightly weak because, GMV growth is in high teens, whereas fashion business net revenue is a lot more muted. So that's been the case for Nykaa over the last few quarters, where beauty has outperformed fashion because of the underlying weakness in consumer sentiment in fashion itself. Let's see how the street takes that.
Okay, all right. So Godrej Consumer as well as Nykaa on our radar. Mangalam, thanks for that. Let's go across to Vinny. Vinny, Metropolis also came out with its Q4 update. How's it looking?
So Metropolis, in terms of Q4 updates coming in, 10% revenue growth is what we're seeing, B2C revenue growth of 14%. And mainly this time the revenue growth is supported by patient volume growth, test volume, also that has seen an improvement. And in terms of product mix, that's seeing an improvement leading to better realization in terms of costs. Operating EBITDA, what the company is highlighting, maybe that could be marginally lower due to some bit of a cost pressure that they're seeing coming in, as well as a revenue growth from what they have seen in the last few quarters, it's a bit lower than that. Yes, they were reporting somewhere around this 13% growth. They wanted that also 13% growth when they spoke to us last time. But this is a 10% growth. But do not forget the industry overall also has performed bad. So in terms of the industry being weak is what analysts are highlighting. Metropolis has managed to see a decent double-digit growth of 10%. Other than that, core diagnostics is going to be a one-off this time coming in terms of costs as well on that front because the cost of acquisition for that. So that is also something that is impacting the EBITDA of the company. Company has cash of around 112 crore rupees at the end of March 2025, and core diagnostics, the EBITDA is at break-even at the end of this quarter, so that's interesting to watch out for. We're expecting some bit of a positive move coming in here, given that it's a decent number, but let's watch out for that.
Okay, all right. Thanks a lot for that, Vinny. Well, let's wind this down with Mangalam on Jubilant Foodworks. Their update as well, pretty good, Mangalam?
Fairly good, Nigel. You're looking at a 12% same-store sales growth for the Indian business, consolidated revenue of 34%, but then again, this includes the acquisition as well. So to that extent, standalone revenue is important, and there too, we've seen high teens growth, 19% growth out there. They've opened 52 new Domino's stores in India, closed 12, so net addition of 40, not particularly bad. Domino's Turkey is where a bit of problem is, where like-for-like growth has come in at just under 1%, and they've opened 8 new stores. The quarter in Turkey ended with 746 stores. We've been pointing out a turn in the QSR space, and it seems like for Jubilant Foodworks, it continues for the second consecutive quarter, a 12% like-for-like growth.
All right, Mangalam, thank you very much for that. IGL, back to Sud. Sud, morning.
Morning, Prashant. So IGL has finally announced a price increase for its biggest market, that is Delhi, which forms nearly 70% of its total volumes. IGL has announced that it has taken a price increase of ₹1 per kg for Delhi markets. Now the new price is ₹76.09 per kg. For other markets than Delhi, which form nearly 30% of its total volumes, for those markets also IGL has announced a price increase of ₹3 per kg. So overall, this is positive, but market sentiment is negative. Do keep this in mind. And in Delhi, IGL has taken price increase for the first time since June of 2024. And for other markets, the last time price increase was taken, that was in November of 2024. But on the basis of news flow, I'm going with green for IGL.
Okay, all right, got that. Thanks, Sudarshan. Back to Mangalam. Mangalam, tell us about Kalyan Jewellers.
Good update coming in from Kalyan Jewellers. 37% revenue growth. We've seen gold prices rise. So as a result of which, these companies have seen their revenue growth come by as well. India operations witnessed a revenue growth of 39%. But the good part is same-store sales growth for Kalyan Jewellers has been 21%, led by robust wedding demand. And they've launched 25 new Kalyan showrooms in this quarter itself. Middle East saw a revenue growth of 24%. And they've launched 14 Candier stores as well during this quarter. More importantly, in the first quarter, we have triggers like Akshay Tritiya and the wedding season. So let's see where that goes as well, especially given the correction that we've seen in Kalyan Jewellers' stock price. The other factor we need to keep an eye out on is the big decline from highs on gold prices. Could that impact inventories for a lot of these companies or not is something we'll be tracking closely.
Okay, all right, got it. So some positive updates coming there. Let's see if they give us a bit of a green hue at all. Thanks, Mangalam, for that. Quick recap of our list then. Stocks with positive news flow include Delivery, Bajaj Housing Finance, Godrej Consumer Products, Nykaa, Metropolis Healthcare, Jubilant Food, IGL and Kalyan Jewellers. Stocks with negative news flow, actually only two, Tata Motors and IndusInd Bank because of its Q4 update. Okay, that's our equity list for the morning. Let's go back to the global picture and see how commodities are dealing with the Trump tariff tsunami, as I'm calling it. Manisha, good morning. What a weekend. What a Friday, right? I mean, everything's sliding. Oil and even gold, for that matter, fell off a bit.
Well, yes, it did. And I'll start with gold first. And it's majorly because investors have offloaded gold to offset losses in other asset classes. We did see gold prices fall below 3,000 as well in the early Asian markets, but there is some recovery right now on opportunity buying. The statement from Powell suggesting that the Trump new tariffs are larger than expected and the economic fallout, including inflation and slower growth, are likely. That led to some buying and coming in for gold, but not the other commodities. They have continued to decline. I'll start with crude oil prices, which are down 3% in Asia right now, and this is after 15% of a decline in the previous week as well. So there's no stopping this one. Even Saudi Arabia has cut official prices for the month of April and May for its Asian consumers, looking at where the markets really seem to be heading. It's unsettling because these are tangible commodities, and this is unsettling for markets and companies as well, with such high moves in the underlying commodities itself. Copper, for one, started Asia 5% lower. Right now, it's trading 0.5% on the higher side. So that's the kind of move that you've seen in the last 2-3 hours coming in for copper. Very large moves here as well. The US-China trade tensions have impacted other metals as well. You have nickel trading at 4.5-year lows, aluminum prices at 7-month lows, zinc prices trading at a 9-month lows right now. So some more slide continuing for many of these metal prices.
All right, Manisha, thank you very much for that. I mean, it's all going in one direction, which is southwards. We'll talk about metals as well in some detail. We have N. Jayakumar of Prime Securities joining us with some ideas and some thoughts. So that's the conversation coming up in just a bit. Okay, N. Jayakumar is with us, Group CEO and Managing Director at Prime Securities. Jake's great to have you with us here. Good morning. You have a plan. So we have, run us through what the plan is with regards to India, Jakes, and how should we deal with this? Go on.
Well, I wouldn't say it's my plan. I just think just taking off from the formula that's been handed over to the world as a whole. First of all, I wanted to split this up into saying, if you look at the way this has been presented, the Trump administration has talked about 10% for everyone and an incremental for each country, which is really a formula that divides the trade deficit that the Americans run vis-a-vis each country, divided by the total exports from that country into America. So in India's case, it's about 42 billion on 80 billion, which means 42 billion of our trade surplus, which is their trade deficit, divided by 80 billion of their imports. It works out about 52%. So we've been handed out a 26% additional tariff. Now it's kind of a moot point, but if you really look at it, almost 10 to 12 billion of that is the Apple exports out of India. But let's leave that out for the moment. India, in a real sense, is not contributing materially to large numbers. The real problem of India seems to be its inability or unwillingness to allow access to markets in India freely, the non-tariff barriers, as they call. So there's an addressing of the non-tariff barriers that need to happen, which is to actually show access to American goods and services into various parts of India. So they've done a bit in terms of Google, etc. recently as a preamble to the negotiations going on. But in hard numbers, if you look at it, 10% is something that we're going to be handed over immediately, or in any case, because that's a global number. So if you take double of that, that's 20%. So 20% of our 80. So we are able to run a 16 billion trade deficit without a problem, trade surplus, compared to 41 billion, which is currently the case. So we need to find a solution to buy 25 billion of American products. We've already committed an incremental 10 billion for oil. That could easily go up to maybe even 15 or 20. And maybe a few other items that can take care of this 25 billion. So essentially the idea is kill this trade deficit number or the trade surplus number from our perspective by buying out 25 billion of American products. Oil we are buying from all over the world, including places like whether it's Venezuela or Iran or Russia or wherever. If we can adjust the basket to take care of close to, I would say, 15 to 20 billion of the oil and oil-related stuff, another 5 billion, and give some noticeable, visible market access. My own assessment is we kill not just the trade deficit issue, which means we go back to the 10% number that's applicable for the rest of the world, but more importantly, give Trump, which is what he's looking at. This morning's interview, he's already said that 50 countries have reached out to him. So really speaking, they're looking to be able to announce wins and some material benefit as a result of the 10%. Now, as you see today, all the other numbers have turned out to be a red herring. And people are now focused on eliminating the incremental over 10%. So the world at large, almost nobody other than China has complained. The EU threatened retaliatory steps, haven't done so. Japan kind of demurred but didn't say anything. Most of the smaller countries have accepted. India hasn't spoken a word. So I suspect what's going to happen is the win for America will be the 10%. The problem really is at the end of the day with China. We'll have to see what Japan, even Taiwan this morning has agreed. Smaller countries like Vietnam have agreed. So if you really look at it, behind all the bluster and the sort of screaming and shouting, I think it is the number of 10%, which is the win for America. And if that can be positioned in that manner, I think they're going to take the win and move on. I don't even think they expected to get tariffs beyond that without hurting demand.
You're saying, JX, that tariffs eventually will be negotiated down to that baseline 10%?
For almost all countries is what I believe.
Except maybe China, yeah.
Except maybe
because it's a $500 billion deficit. It's a much larger problem. They've announced retaliatory tariffs and obviously it doesn't look good PR-wise, right? To kind of sort of try to... So it becomes that... and the crazy thing is if they're on that day, that Wednesday last week, they'd announced 10% tariffs, markets actually, I think, would have rallied. Maybe even 15% markets would have heaved a sigh of relief and rallied. But this is, of course, much bigger. I take your point. You're saying you can buy more of American goods, wipe this slate clean in terms of this deficit that US has with India. It's not much. We anyway buy about $80 billion worth of oil. So you might as well buy it from them, maybe if it's a little more expensive. The issue seems to be they seem to be suggesting that you need to, this market access, etc., which is much harder to do. Non-tariff stuff, it's ingrained, right? It's not, you cannot do that quickly. You can lower tariffs, you can cut tariffs. you can buy more from the US, but they are looking for this, which may take lots of time, and it's a problem not just for India, but for the rest of the world as well. Quick answer, Jason, we want to get a quick market view as well. Go on.
No, I think the important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. There may be 1 or 2 more numbers coming out on sectoral. So I think there is a solution to this. But to arrive at this, he had to raise the bluster, raise the ante, as it were. Having said that, on the market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while. And I think the problem will remain to be China, because China doesn't want to bow down. And on day one, had they indicated 10 for all and stopped there, the same hue and outcry would have happened as to bring down the 10 to 2 or 3 or 5%. So I think this, in a sense, the stakes had to be raised. Of course, there are enough and more markets and different markets that have gone into complete tailspin. And if you look at it, we are still 2-3 days away from the 9th, and they've already talked about 50 countries reaching out to them. So my own feeling is, even from a Trump administration perspective, they can't keep this as a prolonged 2-quarter, 3-quarter kind of thing. This has to be done, at best in a few weeks.
Okay. So now let's talk about what investors need to be doing now, Jake's morning. While this plays out, the thing is financial markets are dealing with this uncertainty, and we don't know eventually what number they boil down to. This meltdown is what's bothering investors, right? And I don't know if India can remain unscathed. We will start about 800, 900 points lower. So we are going to go back to the base of, pretty much the base of the range that we were at, until the March rally hit us. What should investors do? Should they just basically wait it out for the next couple of days till it settles? Should they still be buying every day? What would you tell people to do?
Well, for starters, if it's retail individual, I think please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen, or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are 1 or 2 sectors that are affected in India, which I think will come out unscathed. There are enough and more statements that have come out from Delhi, which indicates that they're doing what it takes to support. But I think one of the things that we will get to see is that this entire Make in India program, which is spurring manufacturing domestically, and if it's for American corporations, and actually, in a sense, paradoxically, increasing the trade deficit, I mean, we'll have to look at something that allows, more goods to come in. But from an investor perspective, I think some of these sharp drops may well, in retrospect, turn out to be good buying opportunities. I still think this 21,900, 2,200 could act as a very strong base, being equivalent to the last time's thing. What happens today, tomorrow, I think it's impossible for anybody to predict. And were I even to try and start doing any of this, it would be stupid. But what I can definitely say is that we could, maybe 2 weeks from today even, but certainly 2 quarters from today, look back and say that is a great opportunity to buy.
I think Jake's fantastic. 10 minutes, punchy and smart take. I really appreciate your time here, Jakes, and I hope officials in sort of Delhi are watching, listening. And as you said, I mean, they've, of course, indicated that they are, of course, in discussions and maybe even in advanced discussions, proposals, etc., with regards to how to mitigate some of these tariffs, etc., which have been announced. Thank you very much for joining us here on CNBC-TV18. We'll take a quick commercial break here. We're going to come back. Prakash Diwan on the other side. Stay tuned.
Welcome back. You're tuned in to Bazaar Morning Call. Well, we're bracing for a rough start to trade, but sometimes these sort of phases in the market throw up opportunities. May not be today, but maybe in the next few sessions. Prakash Thiwan joins us on the show. Hi, Prakash. A lot of news flow overnight. We have news flow on Tata Motors. Jubilant Food delivery has gone ahead and done some inorganic growth at a pretty reasonable valuation. Anything you like among this?
Good morning, Nigel. So, I think the market is in a stage where you would probably, even if you were to like something, you would just keep it on the side and wait for things to settle down. And that's precisely what I think the reaction is going to be. So you'll probably have a market where people will not want to allocate fresh capital, but wait for some of these events to actually start kind of unfolding. But yeah, you're right. Some of these developments, particularly, the way gas prices are likely to come down in India, and of course, crude prices as well. My sense is, you would be better off if you were to look at an IOC or some, one of these OMCs to kind of get into and just ride the dividend yield salience as well. So, that's what you have to do. Very boring trades, nothing very exciting yet. But there's lots that you can start kind of picking or making a short list of, given where things are. And remember, we went up, which was very uncertain. The move up from 22,000 was fairly volatile in that sense, wasn't expected, kept surprising people. The move down is probably going to be a bit sharper, but it's healthier for the market to kind of, get done with whatever poison letting that has to happen. But, this is slightly more global, so it would probably take much longer to stabilize. But otherwise, I think within the domestic market, there's lots of opportunities and valuations that will start seeming attractive, as long as you have the gumption to allocate some long-term capital and not just tactical stuff.
All right, Prakash, just to clear that point, OMCs is something that you're referring to, right? Because of the fall that we have seen in crude oil prices, marketing margins have moved up, the LPG losses as well should come in lower, and valuations are fairly reasonable. So you would like that, right?
That's right.
Okay, got it. Prakash, hi, morning. Tough to navigate this one. Okay, let's talk about maybe one or two stocks that you would buy. The market's going to give you a 900-point sale at the start. So maybe apart from OMCs, anything else?
Good morning, Sarvi. So, if I try to kind of look at things which are completely de-linked from this tariff issues and still have some underlying benefits, the hotel industry in India, for instance, would probably remain fairly insulated unless we believe that tariffs is also going to impact travel, which seems a bit unlikely. But if you look at the hotel segment as a whole, it's been kind of improving in terms of its earnings growth rates and the acceleration that we've seen in some of the pockets, and valuations have started kind of becoming much more reasonable. So of course, one of the favorites is ITC Hotels, and as a matter of disclosure, thanks to my ITC holding, I've been beneficiary of the hotel business as well. But this, at this point in time, I don't know, 200 whereabouts, is giving you ample opportunities to kind of build into the long-term portfolio. So that's one. Then you would have certain companies, certain segments, pockets, and I would completely stay out of IT at this moment, given the fact that it's still very uncertain in terms of how results would happen and the quarters going forward are going to pan out. But the one area that you would look at is businesses that have US presence in that sense. And one of the small companies that Nigel and I keep chatting about is Welspun Corp. So that's something which will start seeing a lot of things. If manufacturing if gas production has to kind of get enhanced within the US setup for whatever reasons, because a lot of nations like India will probably import LNG or be happy to import LNG to offset some of these deficits. And when that happens, you'll probably have these companies, and that's why it's not lost too much ground as well. You look at its price behavior and tell you a lot. The chart will tell you that very clearly. The fundamentals are solid enough for it to be buoyant even in this crisis. So you get a discount, you buy these businesses which will hold steady even in the medium to long term.
All right, Prakash, I had more questions, but we're out of time. I want to ask you about IT, for example, right? And a 9% decline in the last 2 days. For the index itself, stocks, of course, have taken a bigger beating. We'll have you back, Prakash. Thank you very much for joining us, though. A shorter conversation today. We'll take a quick commercial break here. We're going to come back with a pre-open. Sudarshan and Mitesh are going to be with us on the other side. We also will connect with Amit Dikshit, who tracks the metal space closely. That's the other index which took a sharp knock on Friday. He's, of course, with ICICI Securities. Coming back.
Okay, we've started getting the first of the rates. Let's see how this goes. I'm just rewinding back the clock. The lowest point this year for the market has been 21,964. Then we turned around from that point. March was a good month. We had a nice rally come through. Today's gap down is going to take us somewhere close to those lows. Now, this might be a bit excessive. Let's see. I mean, the first rates in the Nifty are far more severe than the implied open. We'll see how it plays out. The sensex rate actually is looking more stable. It's about 3.7% of a decline on the sensex. The Nifty right now is a little all over the place. Let's wait for it to stabilize and then we'll get back to those rates. We have, of course, our technical experts also joining in to help us navigate a morning like this. Mitesh as well as Sudarshan, good morning to both of you. What to even ask? What to do? Mitesh, I think the easiest thing to do is to do nothing, to simply sit out in the first couple of hours. Is that the approach you'll take or what? How do you do a morning like this?
Morning, Subi. So I think, till Thursday we were trading with long buys. Friday, I think, we saw some breakdowns happening in the Nifty and the stock basis. So we started initiating some shorts on Friday. And by Friday end, I think, we had a very neutral kind of approach with positions also pruned out because the way the prices were falling, it was slightly unnatural, I think, because the bank Nifty is very strong, yet the Nifty kept on declining. And I think today when you get a gap down like this and if you don't have much positions, you just sit out. I think that's a fairly good idea because the first 1.5 hours, you will not be very sure whether, after a 9-point gap opening, whether there will be short covering or whether there will be further continuation because I'm sure a lot of put writers will be trapped as well. So it'll be a very choppy kind of a market in the next couple of hours. And therefore, I think the first 1 or 2 hours, 3 hours, I might want to, just be on the sidelines and just observe the markets.
Okay, Sudarshan, morning. What about you?
Well, good morning. All of last week from Wednesday onwards, when we had that big decline, I have been saying do nothing. And you said it's the easiest thing to do, but no, Survi, it's the most difficult thing to do. Do nothing, sitting on an intraday or a day-to-day basis is very, very difficult. But if you followed my advice, and by you, I mean the retail traders, the investors, the short-term traders, then you would be relaxed and smiling as I'm now. I've done nothing and do nothing today. Don't think this dip is going to come to an end. We have not the faintest idea where this market will fall and stop. It may stop after the first 5 minutes. It may not. Just be patient. But there's a sector that I want to point out. Yes, sorry.
Sorry, I just wanted to ask. So, like Mitesh is also saying, most would have anyway wound up their long positions on Friday itself. If someone's still running open short positions going into this morning, at what point should they think of covering? Mitesh, just very quickly on this.
Give a point per se. I think a good way if somebody has short positions is to, always benefit from a windfall profit. So take at least 50%, 60% off your table and then trail your stop losses slightly on the tighter side. So let's say if you get a 9-point kind of an opening, you're short in the Nifty, cover 50, 60% and then take a 250, 300-point kind of a margin and then tail the stop loss over there.
Okay, all right. Mitesh, you go ahead first. Tell us what about the stocks that you're tracking?
So, morning, Nigel. Difficult to say where stocks will open, but I have tried to, figure out at lower level which stocks can be sold. Bharat Forge, if it opens around 1,010, 1,008, a short can still be taken with a stop at 1,030 for targets of 970. Similarly, HFCL, if it breaks 77, and most likely it could happen in the early morning trade itself, then sell with a stop at 79 for a target of 72. On Coal India, the strategy is to sell if you get a price around 380 to about 378. With a stop at about 383.5, 384 for a target of 368. And similarly, Jindal Steel and Power is to sell around 835, 832 zone with a stop at 851 for a target of around 800.
Sudarshan, what would your trades be? Morning?
Yeah. Survi, you didn't let me complete my sentence also.
Please go ahead.
Sorry. Yes.
Go ahead.
No.
Yes.
Colgate is a buying opportunity and ITC is a buying opportunity. Now, obviously, the markets will fall, so the levels are immaterial, but the stocks look interesting. There are two intraday shorts, which is Aarti Industries and Siemens. Again, the levels are irrelevant because we don't know where they will land up, but they are selling on rallies.
Okay, got that. Thanks, both of you. Appreciate your time here on CNBC TV 18. And it's always good to speak with you guys. Well, let's just quickly take a quick commercial break here. What do we have? We have, okay, I think, Nigel, it's your game. Metals in focus.
Well, that's right. Let's get in Amit Dixit of ICICI Securities to give us his view on the metal stocks. Hi, Amit. Well, it's going to be a difficult ride, it seems. Not so much the core fundamentals, but if the global economy slows down itself, it's going to have its repercussions on the metal stocks. Tell us how you are approaching trade with regard to these metal names. They were down anything between 8 to 10% in Friday's trading session. Between the two, ferrous and non-ferrous, is there a preference?
Yeah, hi. Good morning, Nigel. Thanks for having me on the show. Not the best of the times to be here, of course. The thing is that if you look at the tariff, so we have seen this happening earlier as well. Now, the difference between last time and this time possibly can be more of acuteness. However, given the fact that these tariffs typically put a question mark on the global growth as such, which is never good for commodities. There could be direct impact, that is, the export or the trade of steel or aluminium or other commodities, and there could be indirect impact because do remember that steel goes in auto, it goes in a lot of other goods, auto ancillaries, for example, that are themselves exported. And any tariff war definitely has a detrimental effect on the demand as such. And that is what we have been seeing unfolding over last couple of days. In fact, Friday was there when copper cracked 10%. Now still we see that on LME it is down 5%. So this is what we see. Now going beyond this, the usual noise, I believe, will subside in few months. It might take few weeks also. We don't know what is going to be the bottom. But in my view, this is clearly the short-term noise. The reason being that the US itself is short on most of the commodities, whether it is aluminium or steel. Aluminium in particular, they end up importing close to 80% of aluminium that they consume. In steel, they import around 25% of the steel that they consume. So clearly, you are hurting yourself more when you are going ahead with these tariffs. Now, just to answer your question on the distinction between ferrous and non-ferrous, I would say that in case of ferrous, since the consumption growth, domestic consumption growth is something that is holding up, and here we are talking about infrastructure, we are talking about the real local growth, which is quite strong in India. So these stocks that are more focused over there should be seen in a positive light. Non-ferrous, on the other hand, although we like the stocks at these levels, however, these stocks are exposed to the underlying commodity prices. So therefore, there could be a concern on these names in the short term.
Okay, all right. Amit, one of your top buys is JSW Steel. In pre-open, the stock is down close to around 10%, but I must highlight as well that it appears the volume that's got matched is very, very small. So that's the reason the stock is down close to around 9.9%. So as you said, you would like to more domestic-facing themes. So that would be more of the ferrous stocks, I'm guessing. Given that we have that safeguard duty as well that's come in place, the spreads have improved as well, and the domestic economy could do well. From the ferrous pack, what are your top buys?
No, absolutely. Ferrous is something that is our top pick. And if you look at the top buys here, JSW Steel is our top pick in this space. Tata Steel also looks good at these levels, but in Tata, there is a little bit of concern around the fact that Europe is not doing that well. However, I would like to highlight that because of the rearm Europe and all these initiatives, the steel demand in Europe actually can be better in medium term. Remember, we are not talking about the 1 day, 2 day, perspective over here. We are talking about our medium term success, and there I believe that it would be prudent to take exposure in these two stocks. If you talk about the other local stocks like Shyam Metallics, for instance, again, the stock that is totally dependent on local infrastructure, that is one that would be benefited. APL Apollo, again, taking cues from the local infrastructure. That stock also should be in favor, relatively better placed compared to non-ferrous.
Okay, all right. So JSW Steel, Shyam Metallics, APL Apollo at lower levels, they could be interesting buys. What about Vedanta? That appeared like it had value. The stock has seen a one-way correction, 470 to around 400, and we have a special situation that could play out as well. At around 400 rupees, what's the view on that name?
No, so we have our fundamental view is buy on Vedanta. However, and our target price is 610. However, at this stage, as I said, non-ferrous could be more vulnerable to the macro turmoil, and therefore, in the near term, I would say that the ferrous would score over. However, Vedanta does carry a lot of intrinsic value at this stage. I would say that.
Okay, all right. Amit, thanks a lot for joining in. So your preference is towards ferrous rather than non-ferrous. You like the more of the domestic stories, and that's why JSW Steel, Shyam Metallics, as well as APL Apollo are top of the list. Though Vedanta has value, but at this juncture, anything that has global exposure is something that, Amit says you rather stay away and you go for the other stock. So that's the view on metals.
Okay, well, that's metals. Let's look at the final rates with the pre-open having settled. Over 1,100 points of a sell-off is what we are gearing up for. So it's a little worse than what the implied open was indicating. Everything's down. I mean, there's no great genius in saying that. Global-facing sectors like metals are falling the most. IT is, showcasing, again, a fresh round of cuts. Infosys, for instance, 6-7% lower. Relatively speaking, where is the market finding some sense of safety? Financials, yes. And going back to the good old FMCG names where there's cash. So you've got Lever, stocks like Bajaj Finance, ICICI Bank, relatively, they're falling less. Quickly back to Mitesh for the 9-10 call. Mitesh.
I don't know. I think it's much worse than what I thought we opened. So maybe if you can, during the day, get Bharat Forge to sell around 1,010, 1,008 levels, take a stop at 1,030 for targets of 970.
Okay, so short trade on Bharat Forge is what you'll try for. Sudarshan, what about you?
Well, there are two stocks which I suggested, Colgate and ITC, and there may be a buying opportunity sometime during the day. You have to wait patiently and find that out.
Okay, all right. So those are calls coming in as we approach the opening hour. Let's just look at the pre-open will, of course, be up as well. Let's revisit some names, right? IGL is something we got to you, but let's just go back to it. Sud is here with the why. Sud, over to you.
So market sentiment is overpowering the news flow, and that's the reason you can say that despite the positive news flow, IGL is opening with a cut of more than 7%. And remember, the news flow is that IGL has finally announced a price increase for Delhi market, and it has increased price by ₹1 to ₹76.09 per kg. Last time Delhi market had seen a price increase for CNG was in June 2024. And this is important considering Delhi forms nearly 70% of IGL's total volumes. Not only in Delhi, even for other markets which form nearly 30% of total volumes, IGL has increased prices by ₹3 per kg. And as per Jefferies, total price increase for IGL was ₹2 per kg to maintain its margin. But after the sharp fall in the overall gas prices, this ₹1 per kg price increase should be enough for IGL to maintain its current level of margin.
Okay, all right, got it. Thanks very much for that. By the way, I found one stock in green in the pre-open. I should point that out. Godrej Consumer, where the update came in, where the update is not that bad. In a morning like this, it's flashing a little tiny bit of red. Actually, not even a full rupee, but for what it's worth, it's, there. Just wanted to put a little bit of that green on the screen up.
Absolutely.
But otherwise, it's tough.
Let's look at the dollar rupee as well, because that would have opened this morning. And I think we should just take a quick look at it before we go any further. 0.5% fall on the rupee. So it went past 85 on Friday, I think, and Thursday and Friday. There was sharp appreciation as the dollar sank. But, as the dollar sinks, because growth is, the dollar is, of course, going lower because it's pricing in much slower growth in the US. But, when you have massive risk off, people go into cash, people go into the US dollar. And then it kind of starts to behave the other way. So I think some of that perhaps happening as we speak. What do we have? First rates coming up in just a bit. In a few seconds from now, we'll look at it and then we'll come back and look at individual stocks. You don't have stocks opening this lower as you have indices this morning. 5% down on the Nifty, straight up 4.5 actually, 21,831. So straight off the bat, I think we are below the March lows, 21,964, and we should put that out as an alert. 21,964 was the low on the 3rd of March, and we are now opening under the March lows at this point in time. 21,900 roughly is what you have, about 1,000 points lower, 950 actually. All 50 stocks are in the red and of course varying degrees. Let's look at the other indices as well. The Nifty Bank, the mid and small cap indices, and then maybe the IT and the metals index as well. Nifty Bank, which by the way was going the other way. I think the Nifty Bank ended higher on Friday as the rest of the market sold off. Is starting down 3%. Mid cap index is down 5%, and the small cap index will come up on your screen. That is also going to be sharply lower. And by the way, the mid and small cap indices ended with just 2.5% cuts last week. Bulk of it, of course, coming in the last two sessions last week. Is 7% lower on the Nifty small cap index. 1,100 points is gone. And let's just look at the IT index and the metals index as well. And because those were the two which lost the most on Friday. Metals are down 7%. That's a sectoral heat map. Top of the list, and Nigel was just having that conversation with Amit Dikshit. 7% after Friday's, I think, near 7% cut. Nifty IT index down another 7%. Wow. I mean,
after 9% decline last week. IT.
So that is incredible. Oil and gas 5%, and look at all the other rest of the stuff which is coming up with cuts. But let's talk about stocks.
Which ones to pick? They're all down. By the way, there is a recovery. So the good news is that we were down 1,100 points. Gap down was 1,100. And now it's a cut of about 850 points. So let's look at where people are rushing for safety. Interestingly, pharma stocks are reviving, and this will not show up in this. It will show up in those intraday charts, actually. Now, it could be slightly tricky because he said that pharma tariffs are also coming. But for what it's worth, Dr. Reddy's, for instance, has revived a bit. A lot of consumer stocks are seeing buying because that's where you have relative cash safety, and obviously it's all domestic. So Asian Paints, stocks like Zomato, Lever, all of these have recovered big time from their lowest opening points. They're still not positive, but this is where the quick recovery is. Nestle, ITC, these are the names. And then there are financials. Financials also becoming a bit of a hiding spot. So names like HDFC Bank, Jio Financial, from the lows, all these stocks are looking a lot better. ICICI Bank is now down just about 1%. Bharti Airtel, first Nifty stock in the green is Bharti Airtel. About 0.3% of an increase coming in on that one. HDFC Bank fighting hard, but it's still down 2%. Lever fighting hard, still down 1.5%. So Pharma, FMCG and financials, that's where the rush to safety is. But look at the global facing stocks. Tata Steel, 10%. Infosys, 10%. Tata Motors, 8.5%. We all knew about JLR. I mean, sort of explained the math, and it's not looking good for JLR's immediate future. So these stocks are all down in a big way. By the way, Trent is not following the rest of the trend with the consumer stock recovery. Trent is still down 10%. So this is where the deep cuts are. L&T is still down about 7% or so. Tough morning. 960, 970 still down on the Nifty.
Well, that's right. On the Nifty Bank, just one word. At around this 50,000 odd mark, we've opened at around the 20 DMA. On a closing basis, you'll want to defend that mark because now we're down close to around 3% or thereabouts. Even the 100 DMA is coming around this vicinity. The Nifty, well, we have broken the recent lows and we have visited the lows that we saw on the counting day. That's on the 4th of June, 2024. So this is the lowest level we have hit since the 5th of June, to be precise. Actually, we started a little below that. So we made the lows all the way in June 2024 or thereabouts. The breadth of the market is absolutely dismal as we speak. The Nifty is holding around this 22,000 odd mark or thereabouts. The Nifty Bank, that needs to fight for the bulls. That's been the case in the last few trading sessions. But today, that's coming for some selling. We'll have to keep an eye out on the FISL number by the end of today. And the India VIX, I was saying it was well behaved over the last few days. It was up only around 8%. Maybe the street was working with there could be some kind of a deal over the weekend or some kind of positive commentary. That's the fear index. That pops up close to around 50% as we speak.
So yeah, it's It's a long list. Should I count? I don't think there's any point because there is. I think I can see at least on my screen. I've sorted the losers by volume. There isn't much volume on the downside, by the way, to be sure, right? In terms of single stocks, but it's a long list of 10% plus. I can spot at least 25 stocks, sorted by volume, which are down over 10% at this point in time. The meaningful volume right out of the gates is in actually it's just 4-5 names. Maybe things will pick up. But Tata Steel, Trend, Bharat Forge, Anantraj, this Sarda Engineer is down 12 on volume. Never comes up at least at this point. Zensar Tech, Nava, Car Trade. That's it. These are the 5-6 names which have got decent sized volumes coming through at this point in time. Yeah. Bharati is absolutely flat. And down about 0.4, 0.5% or so. But other than that, I mean, you kind of struggle to find stuff which is garbage consumer, I think, as Surabhi pointed out earlier, is kind of flattish as well. So that's the best, right? Torrent Pharma is down 3/4. So this is all India-facing businesses with little to do with, obviously, I mean, what's happening globally, the extent of what's happening will find its way through one way or the other. But in terms of direct exposure, bulk of what is flattish to slightly only small down is things with little US or global exposure. Surabhi?
Just one more thing I wanted to sort of highlight. Even some of the bluest of the blue chip stocks, even in financials, are not being spared. Look at Chola Finance, for instance. Chola is down 10-11% right now. And within consumer also, it's not like everything consumer is going up. Trent or is being spared. Trent was one example, which is down about 10-odd%. There are other names. Look at something like a VIP clothing, 11% down. So it's not like all formats and forms of consumer is serving as a safe haven. It's pretty varied there. And just one more point. Every time the market bounces, it's being met with more sellers. It's that kind of a morning. So while we bounced to about a cut of just 830 points, again we fell. It was again a 1,000 point cut.
There is buying.
I'll tell you.
But the bounces are getting sold into. I mean, that's what seems to be happening.
There's a margin trading facility, right? And that book had gone to around 90,000 crores. The last check number is around 68,000 crores. That could hold us in good stead. The last time around when we fell from the 26,000 mark to around this 22,000 mark or thereabouts, that margin trading book was much, much higher. And I think in the first couple hours of trades, there will be some positions that will be squared off, forcibly by brokers. So that's why you're seeing this sort of a selling. The hope is, as the day progresses, there will be some value buys that will come in there. So a lower margin book actually is a blessing. And hopefully that plays out as well. Because select stocks, they're down far more than what they should be. And we'll have to see how that plays out.
I think, in times like this, it's indiscriminate. I mean, people just go into self-protection mode and they just want to reduce exposure because you don't know. But the question is, as I remember this someone during COVID saying, will the market, it's going to get fixed. COVID came. Initially, we did not know whether COVID is going to get cured or not. But eventually, the realization came that, large companies are working on a vaccine. The vaccine finally came in November. Yeah. Market did not wait till November for things to start to repair. So if markets as collective wisdom know that something is going to get fixed, are they going to wait till the point that it's actually fixed? It's a question kind of worth sort of pondering over.
I think during COVID it was far easier because I'll tell you what, either everyone lived and the markets as well survived, or in fact everyone went down there. So when the markets fell that 25-30% globally, and that was the feedback basically you got. Either you'll make a lot of money or this world is finished.
Also, I think COVID was different because it was all hands on deck. It was like the whole of humanity fighting to get things in order. Here it's, we fighting each other. But to go back to your point, Prashant, and I completely believe that this is one headline away from turning. Who knows, as Bill Ackman has been pushing and saying that just don't implement the tariffs from April 9. Give it a 60-day window. Yeah. One tweet comes and says, okay, I have a negotiating window open for 1 month. Yeah. I'm not implementing on April 9. We know what happens immediately,
Trent is falling
actually. Some stabilities. I think, Nigel, the issue with Trent, of course, is that Trent also rallied about 15% from its recent lows. Yeah. So I think there is that. But I think we should not attribute too much in terms of reasons right now. It's indiscriminate. I mean, it's, if you go looking for reasons why this is down 10 or that is down 5, I mean, I think you're going to struggle. It is just, the market which is coming off for we know the reasons, but it's different books. 100,000 millions of participants. So, but the reason, of course, is the same. 880 points lower, 22,025 is where we're at. Ravi Dharamshi is with us, Chief Investment Officer at ValueQuest Investment Advisors. Ravi, good to have you with us here. Good morning. Thanks very much. So let's just start with your own take on let's work backwards. I was thinking, I'm going to ask you with your take on tariffs and how this gets resolved. I was saying maybe, if Trump reciprocates and says, okay, you cut tariffs and this is what we're going to do. Because right now people don't know how this negotiation is supposed to happen because the tariffs imposed are just so crazy and arbitrary. There is no roadmap. So you need an off-ramp, which we don't have. So that may come sooner rather than later. But we'll get to that in just a bit. Markets first, Ravi. We have broken the March lows, 22,000 and 30, 40. Do you have a take?
No, thanks for that question, Prashant. And I just heard you and Nigel and Surabhi talking about it. I think you guys do a pretty good job at analyzing. I don't know why you need experts like us who anyway don't know anything. No, I'm not joking. I'm serious. It's very difficult to figure out what's going to happen over the next 1 month or next 3 months also. Only thing we can focus is on the long term, honestly. And, we were in the middle of a homegrown correction, which we were doing just fine. And now suddenly this homegrown correction has turned into a global carnage. So obviously new level of uncertainty just got added. Good part is I do believe that this is the beginning of the end and not the beginning itself in terms of the correction. I think what we should understand is that yes, this risk was there, but we were all grappling with how much the Trump administration will follow through on its threats, what they will do, how much tariffs. So the thing is, it's a risk that has panned out. And now we can quantify it. How much is the risk? Can we model it? The variables will still change. The other uncertain variable about this event is how the various nations react to it. And honestly, every other nation might react the way they do. But it is only the China's reaction that matters largely to us, as in largely to the world. Because finally, this is about trying to shift manufacturing back to US. And the biggest beneficiary of this shift of manufacturing out of US has been China or the other conduit nations of China in and around Southeast Asia, Asian nations. So from that perspective, if that is what the end objective is, I think India has not taken away too much of manufacturing, actually holds us in good stead. We haven't only, from that perspective, we don't have much to lose. And we still don't know how the entire jigsaw puzzle falls into place. But I do believe because we don't have much to lose and because we are on the right side of at least being friends with US, there is a possibility that we might actually land on our feet when all this ends.
Yeah, let's really hope so, Ravi. Absolutely. We know that relatively, in an economic or trade sense, we're not that badly impacted, we as in India. I think it's this whole interconnectedness of financial markets that's the issue at hand. I want to focus on one sector in which you've done so much of work, Ravi, and that's pharma and the aggregated chemicals, the related chemical space. And here, I think investors are very confused. First of all, we don't know if he's putting tariffs, if yes, what kinds. We have no clue. But people who have investments in the pharma space right now, what should they be doing? And those who want to make fresh investments, use a day like today as a buying opportunity, should they look at US generics companies or not? Should they look at CDMO? Should they look at API companies? Because it's very confusing in an interconnected world.
Now, first, from the point of view of market, I have no doubt that uncertain times bring good prices, and I think good prices are here. Can they get even better? Nobody can rule it out. But at the same time, if you go back in time, you guys were discussing the COVID times, it was not that easy. When it is happening, it is not that easy. I would disagree with Nigel over there. In hindsight, it looks that it was easy to understand. But at that point of time, we all were grappling with how this world will look like 3 years down the line. We had absolutely no idea. Similarly, we get the same feeling right now that we don't know how this new world, new economic order will look like, what the trading partners will be. But everything will eventually settle down. See, President Trump is in a hurry to accomplish a lot of things in 4 years. Who knows whether he will get another term or no. So from that perspective, what should be done in a gradual manner, he's doing it just in a overnight haphazard manner. And he is willing to risk a recession in US for the same. But coming back to the odds, I think from the perspective of buying from a 3 to 5 years perspective, I think the odds just shot up north of 90%. if you are buying at this point of time over a 3-year, 5-year time frame, you will for sure make money. And I have no idea what kind of a bilateral agreement will be signed or what Fed will do or what RBI will do. But eventually, right action will be taken. And that was exactly the playbook even during the COVID times. We had no idea how the world will evolve, but the people in the powers will take the right action, and that will lead to recovery in the global economy was the point. Coming to the pharma point that you made, I think it is very difficult. In fact, I feel almost next to impossible, at least from the next decade point of view, to shift the pharma supply chain to US. So if that is the case, then all the impact of the tariff hike is going to make the drugs even more expensive in US. Now, India and China are actually the source of making the drugs cheaper in the United States, the generics out of India. Now, I don't see a logical reason why they should be increased. Of course, you can incentivize them to put their plants in US, but you cannot disincentivize or take the supply chain, uproot the supply chain out from China and India into US. So I believe it will be the least impacted sector for sure, and probably it might eventually help out also because the realization will dawn at some point of time that you cannot shift supply chain so abruptly just like that. It might be so that the bulk chemicals or some of the particular sectors might eventually over a 5-7 year time frame do move out, but not the really technologically savvy ones, because you do not have that kind of a labor base, you do not have that kind of an ecosystem at all. So creating that kind of ecosystem is going to take time. From the opportunity perspective, I believe, yes, the supply chain shifting away from China and towards India in the CDMO is something that we should be looking forward to, regardless of whether Biosecure Act comes or does not come. So it remains an area of interest for us, and we will be keen to look at opportunities. That is one area. Second area that we do like is anybody who is integrating themselves into the GLP-1 supply chain, the anti-obesity drugs. Those are two areas where we believe that come what may, if the prices are in our favor, we should be looking to buy.
Okay, so that's on CDMO. That's one part of it, Ravi. You're saying that this is not going to happen overnight, but over the course of the next several years, maybe Indian CDMO players can benefit from a shift away from China. That's point number one. But the more important pressing issue here is US generics. Investors who either have investments already in a Sun Pharma or in a Cipla, Lupin, companies that have a reasonable US exposure, they're all worried. So what would you say to them? Sell your holdings for now if you're sitting on profits, stay invested. What should investors be doing with this large US exposure?
No, so the point of worry in the US facing generic companies is not the fact that there will be tariffs. What is worrying is the fact that their earnings are dependent on one or two drugs. The oral solids has been, sucked dry in terms of opportunity. Revlimid has been a big portion of the earnings for a lot of these companies, and there is not enough pipeline to replace that in the US generic market. That is more of a worry and a real worry for the earnings. Right now, these supply chain related issues are more sentimental, and I would not be too worried on that front. So what I believe is that Indian pharma sector is also now going from being a very homogeneous sector to a much more heterogeneous sector. Everybody is starting to focus on different markets, different product segments, generic being part of the innovator supply chain. So business models are evolving and becoming different and different. So one driver is not necessarily going to be impacting the entire pharma industry in India.
Hi, Ravi. Good morning. Just to correct myself, I didn't mean that it looked very easy during COVID. If hindsight was foresight, we'd all be millionaires. But that wasn't the case. I was just putting a point in terms of feedback we received during that point of time. At that point of time, you pick up the phone, you speak to a couple of large mutual fund managers or HNIs, and that was the broad feedback. Either you go all in, and in fact, you make a lot of money, or maybe you miss out on this opportunity. That said, Ravi, I wanted to ask you about a couple of sectors. What about tech? Tech is something that's absolutely got slammed. There's a lot of uncertainty on the global front as well. But these are very well-run companies with good balance sheets as well. At some point of time, would you think that chipping into this sector would be good?
No, so one thing that bothers me and that has really, I wonder when that will change, is that the sector has not invested in R&D at all. They have been focusing, their business model has been dependent on labor cost arbitrage. And that is where the problem lies. If it is going to be just labor cost arbitrage, sooner or later that will run its course. And we will have to find new avenues. And I think maybe this crisis turns out to be a blessing in disguise. Because eventually, I think, only when you are put in a corner that you start acting and you start behaving like I need to find an opportunity that will last me the next 10, 20 years. And I think Indian IT, at least the large Indian IT companies, have been sorely lacking on that front till now.
Got that. Ravi, slightly more philosophical question. Since maybe indulging in some philosophy is good. Trump during the first term was so focused on the stock markets, right? He'd be proud and happy if the Dow was going higher. This time around, he's been just oblivious. And just last night, a Sunday night, when asked about the stock market, he's okay. He says, well, we need to, the patient needs some medicine, we need to fix it, etc., etc. That runs contrary to he's been very focused on how a president should be evaluated, how high the Dow is, or how good the stock market is, right? And he's a businessman himself. And then you got this in his second term. Can it really be so different? Or it's just a matter of time? It's, as they call it, where is the Trump put? Maybe the put is much lower, but there is a put. And it goes to the heart of the question, will they recognize the pain coming through stock markets and what's happening in the stock market is an indication of what is happening in the rest of the economy? Just a quick take, Ravi.
So philosophy and humor is what will see us through in these tough times. So we have to focus on that. Can't move away from that. But I think coming back to all these politician talks are just means to an end. So one should not be focusing too much on that. And in fact, I would take him literally now. I was used to taking him, not taking him too literally, but I think I would take him literally. If he says Wall Street doesn't matter, then Wall Street doesn't matter. So from that perspective, I think, and it's not only echoed only by President Trump, but others around him, the key part of the core committee, everybody has been echoing the same sentiment that it is finally Main Street that matters and not Wall Street, and Wall Street will follow the Main Street. And their focus is going to be squarely on the Main Street. So, it looks pretty obvious to me that markets is not their priority at this moment, and we will have to bear some pain. And like he says it himself, that this is an operation being conducted, so the patient will take time to recover. But the only question over here is how the other nations respond, right? It is not a one-way street.
Absolutely, absolutely. Operation, patient, medicine. The analogy is all pharma related these days with Trump, right? That's how it is. But I take your point as well that Wall Street is maybe not important. But the thing is, even Main Street is now beginning to protest. There's a legal case that, one particular association has filed. So let's see how this goes. A very, very, interesting and very volatile times. Ravi, thank you so much for joining in.
And the other thing, right? Philosophy and humor.
That is the only thing that will see us through.
It's the best. And if you can merge both, I think that's the best way to do this.
Best case. Thank you. Thank you so much, Ravi, for joining in. We look forward to more advice from you in the coming days. Okay, now we're putting the spotlight on India's electronics industry. The domestic picture is fine. We keep talking about it. But it's really the export situation that one has to understand and address as well. Dixon Technologies is the next company on our radar. Now, HSBC believes that reciprocal tariffs are a potential blessing in disguise, given higher tariffs on mainland China, Vietnam, and Thailand. Let's try and understand this with Saurabh Gupta, who's the Chief Financial Officer at Dixon Technologies. Saurabh, great to have you on. So as you can see from our previous conversations, humor, hope, philosophy, we're relying on everything to get us through this morning. I'll start with some basic stats. And the numbers that I have in front of me indicate that our electronics exports to the US were $10 billion last year. Out of that, more than half was just mobile phones, about 5.6 billion were mobile phones. how is the electronics industry looking at what's going on? Should we really take hope in the fact that there is maybe a tariff war with China, so the Indian electronics industry will still be better off at 26% additional tariff?
Yeah, absolutely. I think so. We have also studied it, and definitely we feel that we are in a slightly more advantageous position, more favorable as compared to the export manufacturing nations, especially in electronics, which is China, Vietnam, Thailand, and all. So clearly, it's an advantage for us, and we think India, over a period of time, can strengthen its position both in the trade and the manufacturing. And clearly, the level of interest has increased. And we are seeing that globally now the companies will increase their diversification from China and invest more in India as far as the manufacturing sector is concerned.
But just a slightly deeper point on this, Saurabh, how would you expect this to play out? And tell us about your exposure as well. I mean, out of Dixon's total revenue, how much is exports? Within that, are you catering to the US market as of now or not? And then what happens? I mean, as of now, that number is 26%. In some other sectors, like for instance, auto, Tata Motors has stopped its JLR shipments till they figure out how to deal with this. For electronics exporters, yourself included, what changes on ground?
Yeah, so for us, I think so our anchor customer, which is, so first of all, our revenues to US markets for our anchor customer in mobiles is almost 5% of our revenues. So broadly 1,600, 1,700 crores is what we did in the last financial year. And that same anchor customer has now told us to expand our capacities because they have a large manufacturing footprint in China. They were already shifting some part of it, and we had some decent exports last year. But now they want us to significantly expand our capacities, and they want us to do a higher portion of their global requirements from India.
Saurabh, hi. Good morning. Interesting times, right? May we live in interesting times. But I think that's so
crazy times. Interesting times are great, but are we living in crazy times?
But that saying, I think, is used as it's not meant as a compliment. It's used as a curse. I think, but Saurabh, so apart from the direct kind of implications, right? How just to your mind, how will this, if tariffs? So baseline is, if there is a baseline, is that eventually something will get done and tariffs will be brought lower. But with China, because they have a $500 billion deficit with the US, it's much more uncertain. They've already announced retaliatory tariffs, etc. Right? What are second order, third order kind of implications over the next couple of years for the EMS industry, in your opinion? Go on.
I think so. India will do a good job relatively. Of course, we're talking about relative today because I feel that India will advance its trade deal with the US, and they are talking about autumn 25. Also, I think so the interest levels in India has significantly increased. India is presently pursuing a lot of these trade deals, almost 7 trade deals right now, whether it's EU, UK, or whether it's New Zealand or even Qatar and GCC have shown their interest. So my sense is, definitely globally, there'll be alignment of the supply chains because tariffs are here to stay. My sense is, of course, it'll of course with Trump, you can always not sure, but my sense is India will always be in an advantageous position, and within India, I think so we will take a larger share of that overall opportunity pie.
Saurabh, have you had conversations? I'm guessing some, phone lines must have been worked, right? Since all this started playing out 2nd April onwards, with this large anchor client in the US, have you arrived at how much of this perhaps has to be passed on to the end customer? How can, say, Dixon as the vendor, absorb? How much can the US client absorb? And how much is the final hit to the customer? Therefore, is there a hit on potential demand, potential volumes going down?
Those discussions have not happened so far. The only discussion that have happened is they have asked us to expand these capacities, and which we are doing right now. And hopefully, our numbers of the export volume should go up. But yes, you are absolutely right. I think so. Somebody in the value chain, everybody in the value chain has to take some part of the hit. Now, how much hit everybody takes, it's something that one will get to know over the period. Yeah.
All right, Saurabh, very quickly, focusing on the domestic new PLI that's been sent to the cabinet for approval. What thoughts out there? If you could tell us how you're planning to address it, investments you're planning to put in?
Yeah, so Nigel, the detailed guidelines should come out in the next couple of weeks. They have broadly announced the contours of the scheme. So as far as Dixon is concerned, we are very much committed, and we'll be making significant investments to the tune of almost 1,000 odd crores in the next 2.5 years, led by display, where we've already signed up with a technology partner in China called HKC. So we'll be doing mobile displays, IT hardware displays, and TV displays. And similarly, we are in pursuing partnership on the camera module side. And similarly, we would also look at other components which are also part of the component PLI. But as of now, this camera modules and is display is something that we are really working on.
All right, Saurabh, we'll invite you back as the story progresses. But I think point taken. Eventually, over a period of time, we gain share in terms of manufacturing and supply chains shifting out, because this seems to be a lot more protracted with China and US specifically as opposed to anybody else. Of course, I mean, they've also got the largest deficits with the US surplus in the case of China with the US. Well, let's just get you some more opinion, this time from India. Earlier, my colleague Sapna Das spoke with the DIPAM secretary, Arunish Chawla, and discussed the government's disinvestment strategy. Just want to play out a quick soundbite here.
There are many smart players in the market. You have to be slightly smarter than them. Expectation theory tells you unanticipated shocks have real effects. So we hit it right. When the mood was Trumpian and everyone was selling short, we lighted a little spark with an OFS, and it worked. It's Honorable Prime Minister's vision that we should share public wealth with our citizens, with the Aam Aadmi, with the ordinary investors. And we genuinely want to make public enterprises a role model in the stock market. We would, and we would also share it with retail shareholders, and we may also decide to share it with the policy holders. We've already kicked the first ball.
Correct.
In the first week of April, and it's given us good results. So definitely we are aiming at that by the end of the financial year. Everything is, going forward like a parallel computer, and you will see results when the time comes. Fingers crossed. Okay. We are hopeful.
All right, that's the DIPAM secretary. Right now, even all PSU stocks are also down, along with the rest of the market. We'll take a very quick break on that note, come back on the other side. We'll have more perspective for you and more conversations in just a bit. Welcome back here with us on Bazaar Morning Call, and we are continuing to analyze the impact of what's playing out on the market. We're still down about 1,000 points. That hasn't changed. Let's pull up the Nifty, still 960, 970 points down. And IT stocks are still taking it on the chin. After a 9% decline on the IT index last week, once again this morning the cuts are as much as 5 to 6% lower. Well, what can the impending earnings season bring for IT companies? It's going to be all about forward-looking commentary, but nonetheless, what about the Q4 numbers? Let's kick off our special segment, Quarter Se Quarter Tak, with the IT preview. Over to Reema for more.
Thanks so much for that. And here's what the IT sell-off tally looks like now. Nearly 17% in the last 3 trading sessions and 27% down on a year-to-date basis. So it's a clear reflection of the macro uncertainty and the sluggish demand. Now let's get to the numbers for the March quarter. No major IT company is expected to report positive revenue growth in Q4. 0 to -1% are the estimates. So it's going to be a very soft quarter for the sector, and the macro uncertainty since the start of the year has only added to the seasonality, leading to delayed decision-making and tighter tech budgets. Let's get the numbers up for you on your screen. According to the CNBC-TV18 poll, TCS is likely to be flat, Infosys down nearly 1%, and the rest of them are likely to report a decline between 0 to 1% on a quarter-on-quarter basis. But the mid-cap IT performance, especially some of the high-growth IT companies, is likely to be much better, particularly its persistent Coforge and Emphasis, where you're likely to see a growth of about 3 to 4%, and for Emphasis, you could see the best growth in the last 3 years. But the fallout of the Trump tariff-induced macro uncertainty is going to hurt Indian IT, at least in the near term. We could see 1, delayed decision-making, 2, stricter, tighter tech spending, budget cuts perhaps, and thirdly, the street was anticipating discretionary demand to come back in FY26, but that is going to be delayed. So with so much uncertainty, the risk is, what if the IT majors decide not to guide? Now, here's what Kotak said in their note last week. It may be prudent on the part of companies to defer guidance until there is more certainty on the demand environment, or restrict the guidance to the next quarter where there is a higher degree of visibility. But if they decide to guide, these are the projections that the street has put out. 2 to 4% approximately for Infosys, but there are some who believe it could be maybe 1 to 3%, 1 to 4% if they want to factor in a wider range given the uncertainty. JP Morgan is at 2 to 5%, slightly on the higher side. EBIT margins for Infosys seen between 20 to 22%. HCL Tech, again, seen largely between 3 to 5%, some may be at 2 to 5%, margins between 18 to 19%. And Wipro's Q1 FY26 guidance could range from -1 to +1. Now let's get to the sectors which are impacted the most and who has the highest exposure. We know retail, logistics, manufacturing, and companies like HCL Tech, Tech Mahindra, LTI Mindtree, and Infosys have higher exposure to these companies. Coforge, Persistent, Emphasis have a lesser impact, according to Kotak. Now, the big question is, after such a big fall in IT stocks, where are the valuations and are the stocks attractive? JP Morgan last week said, keep IT positioning light. Conservative guidance could drag the stocks lower, and that could create fresh buying opportunities. Kotak also cautions that if we hit a recession, there is more downside in IT stocks. If it's just a slowdown, there could be reasonable upsides. Now, the growth projections for FY26 are very muted. We're talking about like low single-digit kind of a revenue growth, and PE valuations are still a tad bit expensive on a relative basis.
All right, thanks very much, Reema, for that. Kavaljit Saluja is with us, Senior Executive Director and Head of Research at Kotak Institutional Equities. You know, on Thursday, when Reema and I speak with the TCS management, I think we'll spend 5 minutes on numbers and 25 minutes on tariffs. But, I don't know what they will say, right? Because no one knows how things are going to pan out. So how can you say anything? Maybe just feedback on what they're hearing, etc. But one way to think about this, Kavaljit, is go back to the last time we had a shock, which is COVID, right? Did we see, from what I remember, we saw the impact was just kind of 1 quarter. I mean, we didn't even see a bigger impact for more than 1 or 2 quarters. And then, is that the right comparison? How would you treat this one?
A couple of differences. First is that during COVID time, the government was the savior for the sector in the sense that they were pumping in money into the market. Maybe this time around, the recession is because of the Trump tariff actions, which is government induced. The second thing is that during COVID, essentially, it was a complete shift towards a digital-only era, which actually sparked a massive discretionary spending revival as such. In the current environment, of course, there is a huge focus on generative AI, so that could be a spending priority, but it do not have the same impetus on spending as you had during COVID. So, some nuances, some differences, to be taken into consideration, when you consider the environment vis-a-vis the COVID environment. Yeah.
Kavaljit, hi, morning. I'm going through your note right now, which is obviously spelling out things as they are. You're expecting a 2 to 5.1% revenue growth decline for tier 1 IT companies in FY25, also expecting a 90 to maybe 140, 150 bips decline in the margin. My question to you is this: for a second, if we park the tariffs and the current issues aside, even otherwise, you were talking about very anemic sort of a growth, mid-single digit kind of growth for at least large Indian IT companies. Now we have this absolutely new reality. So what would your advice be? And we've seen the market deal with it very differently. In the past, whenever there was a massive risk off, you would run to IT stocks for safety. They're cash-rich companies, good companies. That's not what's happening right now. So what is the overall advice on IT over the next at least couple of weeks and months?
Okay, just a word of caution. Actually, the report that we put out today was just a recessionary environment analysis. So if you assume a recession, what could the revenues look like? And against that backdrop, we had come out with a revenue decline in a recessionary environment, correspondingly a margin decline as well. Our base case is a low to a mid-single-digit revenue growth rate for FY 2026 as such. Now, coming to what should investors do, it's a tricky one. Let's say the stocks at the current levels who are basically building in some probability of recession. Let's say there's a full-blown recession, there's still some downside left. If it's just a slowdown, then there are reasonable upsides. So if you basically take a probability-weighted decision, then there are some upsides in Infosys, TCS. Basically, taking a certain probability of recession and certain probability of a slowdown. So there are upsides, in those names as such. So, a fairly, one has to keep their eyes and ears open, essentially, around the macro, especially around what happens in case US hits a recession. If there is no recession, then there's reasonable upside in these stocks from here on.
So base case, like you said, is 0.5% to about not mid-single digit, or is it low single-digit growth for FY26 as of now? This is tier 1 IT.
Low to mid-single digit, yeah.
Low to mid-single digit growth. Got that.
Okay, all right. Hi, Kawaljeet. Good to see you in. Which are the companies that get most impacted, though, Kawaljeet, by what we've heard with regard to tariffs? And they have exposure to various sectors. If you could name the top 2 companies?
It all depends on the exposure. See, right now, the impact will be felt the most by the manufacturing and the retail companies. So the companies which have a fairly high exposure to manufacturing and retail are HCL Tech, LTIMindtree, Tech Mahindra, and Infosys. So those are the ones which get, let's say, impacted the most. If you basically take a siloed impact, just restricted, when I say siloed, just impacted, just restrictions in these particular segments as such. If you assume a broader impact, then of course everyone gets impacted here.
Got that. By the way, another way to maybe think about the impact on IT is discretionary spend, right? Because that perhaps gets... Sorry?
Yeah, that's another lens one can build in, discretionary versus non-discretionary.
So who's most exposed in that sense on discretionary revenues?
Discretionary, it's Infosys and Wipro, which has the highest exposure of discretionary amongst tier 1 IT companies.
All right.
And who's most at risk in mid-cap IT, Kawaljeet, just very quickly?
In terms of, the discretionary exposure.
In terms of overall exposure to US, the recessionary concerns that you just discussed, potential recessionary concerns.
Right. So it will be the likes of Birla. Of course, we don't cover that name, but it will be again companies which have a higher exposure to the manufacturing/retail segment. So I don't know where you classify LTIMindtree, but LTIMindtree will also get impacted.
All right, Kawaljeet, thank you very much for joining us, and hope we can have this conversation soon again, because it's a fast-paced fluid kind of market environment, and earnings will start to come, and we'll hear about earnings. So hope to get you back again soon. But we have the next management ready now.
Well, that's right. Let's shift focus away from what Trump has to say, and let's focus on a couple of domestic themes. Metropolis Healthcare, that's a stock on our radar. They've announced their quarterly update. They've also done some inorganic growth. To help us out with details on that front, we're joined by Meera Shah, the promoter and executive chairman of Metropolis, who joins us. Hi, Meera. Good morning, and thanks a lot for joining in. I was looking at stocks that got hit in the initial couple of minutes of trade and have recovered a good deal. Your stock's top of the list. I think it's recovered close to around 15% from those panic lows. Let's talk about the past quarter, though. You've grown by close to around 10% or thereabouts. I think initially we were expecting a low teens growth, so it's come at a lower end out there. If you could tell us, what was the breakup between volume as well as pricing growth for the past quarter? And how do you see things pan out for FY26?
So if you see, actually, usually H2 is a pretty strong quarter for our industry. Somehow this year has been actually an anomaly. And H2 has been actually weaker than expected. Nobody's really sure why. Is it weather pattern changing, which of course affects health a lot? Is it because of the economic slowdown? I really think it's difficult to gauge exactly what it is. But we've still done well. We've had a double-digit growth in this quarter. That's a sort of a mix between volume as well as the growth which is happening because of the product mix, which results in sort of an increase in average revenue per patient. So still a good, reasonably good show, but a little bit lower than we were hoping for as well. I think we're going into FY25-26 very excited around, how the year will shape up for us. We feel quite strongly about the growth that we hope to be able to drive organically for the business. Plus, we have closed 3 acquisitions, the third of which we announced this morning. And all these 3 will also play out into the year, into the entire year of FY25-26. As I had mentioned last time, we're building a string of pearl strategy across North India, as we are leaders in west and south of the country. And north, we've been challengers, maybe in the top 5, but definitely not number 1 or 2. And the idea has been to say, how do we really bridge the gap and get much stronger in the north? So we decided to partner with the leading pathology labs, which are very scientific, ethical in nature, not necessarily only in Delhi, but across the north, along with the core Diagnostics, which of course is a leading cancer testing platform and majority of business in north. So excited about how this will play out next year.
All right, Ameera, you said that on the domestic front, there could be some challenges, which that's why you could have grown a little bit lower than what you would have expected. At least you're not dealing with President Trump, right? And those tariffs out there, so much of uncertainty. So, thank God for small mercies. Give us a little bit of an insight. You've done a net price increase, I think, of around 2% in Q3. For Q4, was there any price increase that you pushed through? And if you could break up the performance, across segments, how was the wellness segment, specialty, acute? How did they do in the past quarter?
So actually, wellness and our bundling, which is called True Health, actually continued to do well, close to almost 19-20% sort of a growth. What we saw actually falling was the acute segment, which is majority of the business in Metropolis, which is actually illness, which is obviously not on demand. And it's actually when people fall sick and therefore need to come for testing. And that's been true not only in diagnostics, but across the spectrum, we believe, for healthcare. Across pharma, across hospitals, across diagnostics as well. So, when it comes to illness, which is really a need-based testing or hospitalization, a lot of it we see is linked to weather patterns. A lot of it is linked to, seasonalities, outbreaks, etc. So it's not something that we can really have a control or very deep influence over. But of course, the wellness side of it, which we do have an influence over, we did see a fair bit.
By the way, Ameera, good morning. Prashant here. On a lighter note, right? I think there's a real market gap to introduce a stock market package. Given the volatility, I don't know what would be included in a
definitely cardiac
package. Cardiac, and there'll be a BP and maybe
blood glucose.
Your general temperament, if there's way to measure that, right?
No, absolutely. We have a white list package, which I think would be very important for all stock market participants, considering what's happening right now. And like you said, small mercies, we don't have to deal with tariffs. We actually are in a very strong structural growth environment in our industry and domestically. So we have a little bit more control than most other people in the markets right now.
Absolutely. Okay, Ameera, quick last question. You've done a small acquisition, that Dehradun entity. I think you finished that, it's been announced today with 35 crores, I think, is the value. Last updated numbers, what we have is, I think you had a cash level of about 110 crores. So are you spending 35 crores from that? And as we're looking at this new year, what is the strategy? What kind of growth, top-line growth would you target? How much organic and how much would be inorganic if you're looking at more inorganic ideas?
Yeah, as of now, the 3 acquisitions we've announced will be funded from internal accruals. If maximum, you may need like a 10-20 crore working capital line, but nothing more than that. Most of it will be internal accruals. As I mentioned, I think FY25-26 is an exciting year. The team feels very ready to jump into this year with the very strong network expansion that we've done this year, a lot of strong programs around product, and feeling quite confident that the organic growth in 25-26 will be really great. And obviously, the goal will be, now that the acquisitions have been announced, to close them and then to integrate them to get the IRR that we need from these investments. So North India will be a big focus for us. So very excited about that.
All right, Ameera, we'll leave it there. Thanks very much, and wish you all the best of luck as you continue to execute there. Well, I think we're around 940 points. So, recovery may be a little bit from the lows, but any bounces, of course, are also not lasting in that sense. So 21,970 is where we're at. Mitesh is back with us with what he's making of the price action so far. So we're exactly at the March lows. 21,964 was the low on the 3rd of March. We're at 21,960. Mitesh, what's any trades here?
Yeah. So Prashant, one, I think, on the index, people can look to get into some kind of put spreads or bear spreads by the 2000 put sell 21,500 400 ratio of about 1:1.2, 1.3 kinds. That's one strategy on the index which could play out well, given the fact that I think, with the kind of put writing which might, writers which might have been caught out with the gap down today, I think every bounce back will face supply at higher levels. And on the stocks that I have one buy and one sell, Britannia, I think, is a stock which is recovering well. That's on the buy list. Buy here, the stock just below levels of 49.30, look for targets of around 5,100. And Tata Steel, I think that's these stock which I would suggest sell call upon. It's already down, but yet I think the stock could see some more declines. So keep a stop at about 131. Look for a target of around 120.
Got it. The Tata Group entities. Thanks for that, Mitesh. By the way, 3 Tata Group entities at the bottom of the Nifty tally. Tata Steel, the stock that Mitesh was just talking about. Tata Motors is down 10%. And look at Trent. Trent is down 18% right now. It's a big, big hit for these 3 Tata Group entities today. Let's take there we go, Trent, 18% lower. We'll take a break right now, come back and see what's happening with commodities now. Equities obviously reeling under the impact. Back with commodities in just a bit. Welcome back. So equity slam dunk. Let's see what's happening with commodities. Manisha, do you have any better news for us there?
Well, only if you're consuming those commodities. They've slightly gone cheaper right now. But, this is insane. These are tangible commodities. This is what you use in companies and everyday use. And the kind of big volatility that we've seen in many of these commodities is something that we haven't seen in many, many years there. I want to start with crude oil prices because we've seen 3% of a decline in the Asian markets. The prices did fall 7% on Friday, 15% down now in the last week. And for this year now, we're down by 16%. And this is a third straight year that the crude oil prices are trading in the negative. When you look at the overall international markets, 80% countries import crude oil. So this clearly is good news for them. But the kind of scenario this is coming in on the background isn't so great. So larger than expected U.S. reciprocal tariffs is something that the street also saw some decline because of. And then you had China coming out with the retaliatory 34% tariffs. And these are 2 major consuming countries. And that's where the reaction is coming in from. But apart from that, it also is about planned production increase from OPEC and allies from the month of May has been 3 times more than what the street was anticipating. And then apart from that, on Friday, there was a report from Saudi Arabia, an official notice saying that they are cutting official prices for their Asian consumers for the month of April, the ongoing month, and for the month of May to the lowest in 4 months. So clearly a demand can be a hit and they're lowering prices already. In any case, the crude oil prices have come off and that's what Saudi Arabia is reacting to. The dollar index also stabilizing at 103 has had its impact. So when you look at the trade today, we've seen big volatile moves coming in. At one point in time, we saw the gold prices decline all the way to 2,997. It's trading at 3,040 right now. So $80 to $100 of an intraday move coming in for many of these commodities, especially gold, is unheard of. But that's exactly what we are looking at. I want to show you on what we've done in sense of last 1 week in reaction to all of these tariffs. So the Brent crude prices clearly have been the most hit, 15% of a decline in previous 1 week coming in for the crude oil prices. Silver down 11%. It's trading 2% on the higher side right now. Gold also has seen a sell-off, offsetting the kind of losses that you've seen in other commodities. That is where it's gone down as well. But as you can see, 9% of a decline in platinum, palladium, and the base metals should come in on your screen because the last 4 or 5 trading sessions have clearly taken a hit there. Copper, underperformer in last 1 week, 12% down, but we saw all-time high in the month of March on that. So that decline is something that the street would have expected. And 5 to 8% of a cut coming in for aluminum and zinc. Rubber, cotton are down 8 to 6% as well. This is agriculture, industrial commodities. And with China coming in with such retaliatory strong numbers, you are looking at many of these commodities declining as well.
Right, Manisha, thank you very much for that. Some crazy moves in unhinged kind of markets, and gold falling. Gold is still a safe haven. It's just that, I mean, that's getting liquidated along with everything else as well. But big recovery as well, back above $3,000 on gold prices. We take a quick commercial break here. We come back with the economy. It's the economy. Latha in conversation with Stephen Englander of Standard Chartered Bank and Robert Sockin of Citi on how the US economy will be impacted by tariffs and what's in store for currencies and bonds. Stay tuned.